interactive investors panel on many topics, including the future vision for FinTech, led by Zane Schwartz, who's a senior reporter at The Logic. And if you haven't yet subscribed to The Logic, they do deep reporting on the innovation economy. It's absolutely fantastic, and highly encourage you to become a subscriber if you haven't done so already. So if you have any questions for our investors, this is a live interactive session. Please send them through the public chat, and Zane will be actively monitoring and help you get your questions answered by our esteemed panel of investors. So at this point in time, I'd like to hand it over to you, Zane.
Thank you so much. Thank you for the warm introduction. We're very lucky to have with us an all-star panel of FinTech investors here. And just to reiterate, please don't hesitate to ask questions as you think of them. We'll get to as many of them as we can. We have Peggy, who's the managing partner of Aurora Growth. We have David, who is the general partner at Luge Capital. And also David, but we're going to go with Dave for ease of understandability, Unsworth, who's co-founder and general partner at Information Venture Partners. So I know you know all of those names very well, three of the top firms in the country. Lots of topics that we want to get to. To start off with, for all three of you, what advice do you have for founders during the pandemic? And Dave Unsworth, why don't we start with you?
Sure. I think the immediate advice that we gave all of our founders and our portfolio companies was to start thinking very proactively about cash conservation and sort of understanding, how much liquidity they had and how long they could run. And unfortunately, with early stage technology companies, most of the ways that you save money is really related to the team. And so we had to make some very tough decisions, I think, across the portfolio on letting people go. But as difficult as all those human considerations are, if the company doesn't survive, then everybody's out of work. So it was sort of a lot of, I think, hand-holding and advice. And a lot of what we were telling our portfolio was informed by sort of our time through 2001 and 2008, where we went through these kinds of cycles before. And so really focused on 24 months plus of cash runway. I'd say pleasantly, tough decisions were made, and our exposure is largely B2B, so we don't have a lot of B2C exposure in our portfolio. So many of our portfolio companies actually ended up doing a little bit better than expected. And so while that's great in this near term, I think we're still very much expressing a sort of a cautionary tone. I think when a lot of this liquidity that the governments have been pumping into the market dries up, we may see a second coming of a recession or a slowdown or an elongation of sales cycles, and I think we still need to be sort of prudent. And then the other real advice, just to finish it off, is I think we've been really telling people to focus on the teams that they have, the partnerships they have, the vendor relationships, because all of that sort of trust and goodwill gets built up during difficult times based on the way that they behave. And so take this opportunity to really deepen those relationships, because you're going to need them to survive this. And figure out what are the permanent changes to your company, the permanent changes to the business models, because I think there is going to be a lot of permanent changes coming out of this. So what are temporary and what are permanent, and how do we adjust our businesses to reflect this new reality?
It's all very helpful. Thank you. Peggy, what advice do you have?
Thank you. So I have three type of advice that are really tactical. So the first thing is really, as much as you can, align your pitch, whether to clients or to investors, to the theme that are very relevant in the context of COVID. So obviously, digital channel, digitization, cybersecurity, all these themes. Based on your business model, try to attach your bandwagon to that, but it's going to give you probably a bit more airtime with that type of thing. So that's more sales and marketing advice on that. The second thing is be aware in terms of valuation of a disconnect you might have between what you thought your valuation was 2 months ago and what investors are looking at right now. So a larger bid-ask spread between investor being conservative and you maybe being still pegged on pre-COVID valuation. So that's the second thing. And the third thing is in terms of liquidity. Obviously, before thriving, making sure to survive. Dave mentioned, cash conservation. You will probably need as well some bridge financing. So if you were raising a big raise, unless you're one of these companies who's really profiting from COVID, and that's good for you. But if you're not in that situation, try to go with a bridge financing that's going to bring you, like further down the line, so you don't have to take too much of an haircut on your valuation for your next raise. So that's really my free type of advice.
All really helpful. Thank you. David?
I totally agree with what was just said. The only one point that I would add on top of that is that founders need to take a very conservative look at their sales estimates that they believe that they're going to be able to achieve. And during the first few weeks, there were some founders that were saying we're not going to be affected, or we still believe in our sales pipeline, and the vast majority of those have had to revisit it, but that came very late. I think founders need to take a hard look at what they can really achieve, and it's better to overachieve that than to underachieve it.
For sure. So that's all very helpful advice, like maybe partially for portfolio companies. Talking maybe a bit about potential new companies. Are you investing in new companies during the pandemic? And if so, what are you looking for from firms, maybe from someone who might be listening and thinking of pitching you? Why don't we start with Peggy on that?
Well, I think like many funds, the goal was to de-risk the portfolio companies we already invested in. So the additional money I've been allocating has been for companies I've already been investing in. So not so much in new businesses. I think that depends on funds, that depend on where they were with their own fundraising as well. Obviously, we have to fundraise as well, so there is a bit of a cycle here. So that was my position.
David, you recently announced a $16 million round in Flinks during the pandemic. How are you seeing this question? How are you thinking about investing in new companies?
So for sure, we're reinvesting in the best of companies of existing portfolio. Those that were struggling before, even more struggling even more. But in terms of new investments, we're active in looking for great companies. We're a long-term asset class, so we don't get very excited about. Well, today, because of the pandemic, we're seeing a huge demand. We're looking longer term in why is this business have legs? Do they have a strong team? Obviously, and all the things that we're looking at. But there are definitely categories that are more attractive than others that we think are going to become the new normal, where certain innovation agenda is going to be prioritized inside of fintech, inside of financial institutions. So we're looking for businesses that have, obviously a long-term play, and that there might be tailwind, especially post-COVID, inside of those companies. For sure, we're a little bit more, conservative on making sure that this company is going to be hitting milestones. They're going to be sufficiently capitalized for the next 24 months, that their targets are achievable, and that the fundamentals are there. There was a lot of exploration before when there's a lot of money in the ecosystem. I think, not just ourselves, but everybody else, you're looking at, a little bit more of the fundamentals, a little bit more proof points on those companies. And I think it's sort of shifted a little bit more towards some of those proof points.
You mentioned there's specific subsectors that you think may do well. What are those?
Yeah, so we're lucky to have a bunch of financial institutions that invested in us, and we have calls with them on a regular basis with their innovation teams to find out how their innovation agendas have shifted. And the obvious one that keeps coming up is there's very little face-to-face happening, right? Whether you think about life and health, how are you going to evaluate somebody in order to give them a life insurance? How are you going to provide them with a fully digital experience beginning to end from quote to bind? So we're seeing insurance companies trying to think about their total digital transformation, and they have significantly accelerated that. Things like digital payments, right? The lack of cash is not being used. How are we being more innovative in the way in which we're better servicing customers? And probably another good example too is the spike in online lending has significantly increased, and there are technologies that help to provide that experience without necessarily having a ton of humans that are doing all the underwriting, the document collection, reviewing, and so on and so forth, and trying to filter that from the top of the funnel using a bit more technology and automation. And I'll just give one other really quick example. Insurance carriers. You would be amazed on how many of them receive checks and paper receipts. Well, when nobody was in the office, that was a major problem. You had to have somebody that scanned those receipts, sent them by email to somebody. And looking at that just as an example of trying to do digital transformation is getting rid of all the paper.
That's a great anecdote. Thank you. Dave, how are you thinking about making new investments these days?
Yeah, well, I'm going to echo a lot of what David said, just because we have a very similar focus and I think a very similar perspective on things, and in terms of the way our funds think about things. I think if we're struggling with something right now, it's how do we end up doing new investments with entrepreneurs and founders that maybe we haven't spent a lot of time with before, or nurtured a relationship with before, especially when we do a fair amount of investing in the US as well. It's very difficult, and maybe I'm old-fashioned, to pull the trigger on an 8 or 10 year long-term relationship with somebody I can't spend a fair amount of time with. And so I think what we're all grappling with as VCs is, how do we do this in a virtual environment? How do we spend that time? How do we build those relationships? How do we do the due diligence when we can't be on site and can't meet the management team in person? So, I'd say generally it's taking some time, and we're just we're just taking our time and trying to figure out what that process would look like. That said, we did complete 2 deals that were already in flight in the early part of the year. So,
thank you. That's very helpful. Shifting gears a little bit, I wanted to talk about the regulatory front. So in May, the federal government delayed open banking consultations until at least the fall, despite lobbying from some fintechs to expedite the new regulations. And in June, Ottawa rejected a proposal by multiple fintechs, including PayPal, Wave, and the Canadian Lenders Association, to distribute COVID-19 aid for businesses. Why do you think fintechs have been unsuccessful in their recent government lobbying efforts? And maybe we'll start with David on that one.
Yeah, sure. Really good question, right? The government, like everybody else, has been hit with unprecedented agitation to the economy. They've needed to focus efforts, for short-term, mid-term impact for Canadians. Open banking clearly is a priority. As for aid for businesses, right? The federal government set up a massive programs to help capital and struggling businesses, and I think those have strong merits. Yet, they had to prioritize really the way in which they were going to be deploying that capital quickly, right? So to go and choose a bunch of fintechs to come into the mix and help deploy that capital in the spirit of time, I mean, that's realistically it's not really feasible. But I think these programs really did help. I think that they were done extremely quickly. I believe that open banking will come in some form or another in phases, if you will. But just the timing is just really off right now, given the priorities of COVID.
Totally fair. Peggy, how are you thinking about regulatory issues, open banking, that kind of thing?
Well, you have to keep in mind that there is a very symbiotic relationship between the government and the financial institutions in Canada, we're obviously an oligopoly. So the banks employ a lot of people. So it's not that easy to think that the government's going to take decisions in terms of new regulations that might actually be playing against very important players in the space. And keep in mind that Canada has the most stable financial system in the world, as it was shown in 2008. So this symbiotic relationship somehow can be valued because it brings us stability. On the other end, the customers in Canada are the ones who are paying the most for their financial services product. So how do you balance that? So I do think at some point open banking is going to come, but I don't really see the government seeing that as a priority. First, because as David mentioned, there's other stuff that are priorities right now that are probably more important. But also, I'm not sure there is such an incentive to open the playing field against players that have been extremely supportive in the past, regardless of the color of the government, just as a context.
Totally fair. Dave, thoughts?
I'm not sure I have anything to add on top of that, to be honest. I think just, the progress against open banking is going to take its sweet time, just with all the regulatory overlay and whatnot. And these things just take time. I think the government had to move fast and used, I think, BBC and other government entities as their ability to get things done quickly.
Perfect. And that is always an acceptable answer, by the way, because we have lots of questions to get through. And actually, I'm going to stay with you, Dave, for this next one. So in the US, many banks are partnering with fintechs to improve their tech performance during the pandemic. Information Venture Partners portfolio firm Sensible, for example, announced a partnership with Chase for digital receipt management, I think for 38 million customers, about the same number as there are Canadians. Do you think the pandemic will accelerate these types of partnerships between Canadian banks and fintechs, or is this more of a US phenomena that we're seeing?
Yeah, no, I think it absolutely will accelerate it. We've seen it across our portfolio, and I think David touched on it before, and I think Peggy also. But certainly, anything that's assisting with the digital processes or digitization of legacy processes, removing that face-to-face contact, digital onboarding, digital payments processing, digital receipt management in the case of Sensible. There's just a whole bunch of different ways that the larger incumbents are thinking about how to reinvent that sort of previously in-person retail story into something digital. So I think you're just going to see more of that. And I think there's been a lot of tailwinds around the adoption of cloud and improved security and other things that are allowing for some of these partnerships to really sort of flourish.
For sure. Peggy, what do you think? Will we see more partnerships?
Yes, I do believe we're going to see way more partnership. COVID has basically accelerated a lot of trends that were already happening before. So, we saw partnership in the past. They were not always put together very swiftly. Hopefully, it's going to go faster. To Dave's point, the fact that banks want to accelerate their digitization of the back office, digital channel in the front office, doing that with partners is really, really helpful. But also keep in mind that they are going to decrease their own tech budget and their development budget. And instead of developing internally, partnering with a company that has already developed all the tech is way less expensive. So there is also a good opportunity for them to manage their budget down with strategic partnership.
For sure. Thank you. David?
And I'm gonna quickly kind of backtrack because I think it's tied to it what Peggy said about open banking. And I agree that the challenge of getting very, very large financial institutions open up their data kind of creates this competition, and there's this double agenda right there. But the early stage companies, or especially tech savvy companies, are finding ways to work around that. Right? They are scraping data. They are doing things in a way in which they kind of force these partnerships, which makes a lot of people uneasy. So I think they're going to try to, put some framework around that. And that also helps partnerships. And I think that's also motivating financial institutions to figure out secure ways to partner with early stage companies that are servicing their customers. Are the financial institutions that invested in us, like Sun Life, Industrial Alliance, Desjardins, even BDC, are all looking at ways in which they can accelerate their innovation by doing some partnerships. Much like IVP, we're not a lot of B2C, but we're seeing a lot of B2B partnerships that are happening in the back end that maybe consumers don't see, where there are companies helping them reduce fraud, They're helping them in automation using AI. They're helping them with cybersecurity, especially with remote employees. These kinds of partnerships are also creating revenue for early stage companies. So, and I think that those are some of the really interesting partnerships that can be done, which might not be customer facing, but might enable more to do for the customer.
I think that transitions well into what I wanted to ask you guys about next, which is, as the title of the panel is about the future vision of. I know it's hard to make predictions in the middle of a global pandemic and recession, but how do you think the pandemic is going to change the fintech landscape in this country? What if you had to predict something, what will be different in the space, let's say 12 months from now, because of what's going on today? I'm gonna ask Dave to start.
Sure. I mean, boy, if I could crystal ball this accurately, I'd be the best VC in history, but because you'd hit all the right spots.
You've got a pretty good portfolio.
I think that's hard. Look, I think like always, coming out of any of these really sort of systemic shocks, I think anything in the governance, compliance, and risk area will continue to absolutely be important. Cybersecurity, they are two big themes for us, but I think you always see new regulations and changes to regulatory environments coming out of these kinds of black swan events. I think some of the more interesting things that we've been thinking about very carefully. I mean, we're a B2B fintech fund, and we've always defined the B and B2B fintech as large financial institutions or small and medium-sized financial institutions. But I think what we've seen during this pandemic, and I think what we expect to see a lot more of, is the rise of big tech as the B and the B2B fintech. So a lot of the big tech companies are thinking about how they become banks, how they process payments, how they provide supporting infrastructure or banking as a service. So I think going forward, I think a lot of our portfolio companies could end up selling to big tech as much as they do into financial institutions on that B2B side. And and the last bucket remains that that our face-to-face interactions are forever changed. So what are the technologies that are going to change the future of those sort of interactions and onboarding, payments, relationship management, and that whole wealth management areas? Everything's going to get turned on head. So those are the areas that we're thinking about actively.
That's really interesting. Peggy, are you seeing similar things? Do you think that there's going to be more partnerships with big tech?
Yes, well, what I believe is going to be really interesting in the space is a growth in terms of focus in impact investing. So from a regulator's perspective, a client's perspective, and an asset manager perspective. So I think that's one of the positive of the crisis is the fact that there is way more interest and emphasis on that. So you can already see in Europe an acceleration of regulations to make sure you don't have greenwashing when you say that your company is actually in the impact space. So fintech can play obviously a great role into that in supporting more. I'm thinking about the company I invested in, Impact Finance, that is a credit score for impact investing. Well, that supports exactly that. If you look at the trends, secular trends, there is a money transfer towards millennial and towards women who are historically more interested in sustainable investments. You add to that the trends we've seen with COVID, you're going to see more of that. I think Blackstone announced 2 days ago they made a very large investment in Oatly, a plant-based company. I wouldn't have bet that Blackstone would invest in that type of organization. So I think that's a great space to be.
Really interesting. David, if you had to make predictions, what do you think the space will look like?
I think the current situation has challenged a lot of, like I was saying, in insurance face to face, and the whole broker channel that services customers got a real realization of how they're going to be stirring up business, and the digital transformation inside of the whole broker channel is going to accelerate significantly. I think so we like a lot, and we've actually published on our website ideas and sectors that are of interest was the way in which I think the whole broker channel is serviced, whether they're financial advisors or insurance. The other one is, in terms of lending technologies, I think that there's a lot of improvements that can be done there for financial institutions, whether it's in mortgage, whether it's in credit lines, alternative credit as well, like Peggy mentioned, alternative credit scoring for new immigrants and people that have thin credit files. Like Dave, we don't have a crystal ball, but I think there's trends that are happening in insurance. We've seen this. We're seeing a huge increase in demand for insurance due to the pandemic, right? The people start to rethink about, well, geez, what's my life insurance like? What's my health insurance like? Whether in Canada or the U.S. And I think these are creating long-term changes that can be addressed by some early-stage innovative companies. Security for sure, remote workers. As you have more digital transformation, you have more people that end up being scammed from phishing attacks, employees that are clicking on a link or gaining access to downloading data to their personal computer or their devices. So, security, anything digital transformation in insurance, in banking, and also probably a last point too that I think is really interesting is the challenger bank and the B2B. Right, you have this whole kind of layer of small SMBs that are being started by a younger generation that don't want to walk into a bank and go through all the process of opening up a bank account and then plugging in for automation into their payment account, their Visa account, automated accounting. So the automation layer for small B2B, I think, is another one. So throwing out a couple of ideas like there. But we're opportunistic.
All great ideas. So we've got less than a minute left. I'm going to try to squeeze in one last question, which I always like to ask VCs. And I haven't told these three about it beforehand. What's one company that you're excited about that is not in your portfolio? Ideally a fintech. Peggy, please, go ahead.
So, Plassche. And I'm not sure if Dave and David knows it. Very, very interesting. Yeah, you do really love these guys. I don't know, randomly, I spoke to them 3 times in the last 2 days and really, really like the organization. So,
what kind of company is it?
Oh, it's on the data privacy and cybersecurity space. So it's very relevant right now. And we already have a great partnership with a very large FI here in Canada. So great traction.
Perfect. Thank you.
Peggy,
Dave, do you have...
I was talking to David about that just the other day. He's lucky enough to be an investor.
So great minds think alike.
Do you have a company that you're thinking about, Dave?
Yeah, there's a bunch, but I certainly like companies like Savvy or in the mortgage space, or BitLift that's in the SOAR, which is a cybersecurity segment, security orchestration.
Perfect. Thank you so much. And David?
Such a hard question because you give away your deal flow. But no, Pro Navigator is an interesting company growing very quickly. Pro Navigator is a Toronto-based company that uses automation and NLP so that the whole broker channel doesn't have to call up an insurance carrier and ask them questions. They get access to all the policies, and using NLP, you end up getting the answer from these 150-page policy documents. So I think that's a really interesting application of machine learning and NLP, natural language processing.
Perfect. Thank you. And we're just barely over time, so please join me in thanking our wonderful panelists. And do stick around. There's a lot of great programming left today afternoon and in the weeks to come. Craig, back to you.